Another day of bloodletting in the financial markets, and growth concerns are probably still the reason why. Ugly, ugly day for U.S. stocks today. That's despite a narrow beat on benchmark Nvidia's earnings. Was a smaller upside surprise than expected, but the markets have shrugged off much worse, and they are clearly not doing so now. We have the lowest close for the S&P 500 here since the middle of January, lowest close for the Nasdaq despite those earnings since early November, the lowest close for the small cap Russell since mid-September. So it is bloodletting across Wall Street today. And we're going to take a look at what this is likely to do from here as we get the first bit of actual macro data for this week. That's what we're here for. This is Macro Money, after all. I'm Ilya Spivak, head of global macro here at tastylive. And we're going to unpack here a little bit of what's going on, a little bit of why this sell-off is occurring, and then take a look at what we might see as the first opportunity for substantive macro data since last Friday to influence the story and what that influence might be. And of course, what we are talking about here is U.S. personal consumption expenditure, inflation data, the Fed's favored gauge of price growth. But first, let's get a bit of background here just so we know what we're talking about. So this right here is really the genesis of this most recent bout of liquidation. And what you see here is the S&P Global Purchasing Managers Index for the U.S., and what you find is that over the past 2 months, there has been a dramatic unraveling of the service sector. Now, the service sector is, of course, the dominant part of the U.S. economy, and you can tell that with the naked eye. Just take a look at these numbers and see that the composite index, the one that takes in both the service sector and manufacturing, tends not to track manufacturing, but tends to fall almost exactly in lockstep with services. This is not unusual at all for a developed, rich world economy. In fact, were you to look at these numbers for the Eurozone or the United Kingdom or many other parts of the sort of mature economy universe, the G10 universe, you'd see pretty much the same thing. Close to 70% of U.S. economic growth and close to 80% of U.S. employment is powered by the service sector. So to see this kind of unraveling in service sector growth is, not surprisingly, something that spooks the markets and tells them that there is some sort of a meaningful deterioration occurring in U.S. economic performance. Now, lest we start to say, oh, this came out of the clear blue sky, again, let's note here, yes, it is certainly the case that when on Friday last week we saw the February set of these numbers, they gave us the first contraction in the service sector in 25 months. And that's certainly eye-catching. No question there. Just to quickly establish how we're using these variables, the way that these PMI numbers work is they have a median line at 50, which represents neither growth nor contraction. Above 50 is expansion. Below 50, economic activity is shrinking. The further you go above 50, the faster the expansion. The further you go below 50, the faster the contraction. So when you see that 49.7 on the service sector in February that you have on the chart there, what you're seeing is the first time that the services index has slipped into contraction territory since back here. And so this is really eye-catching, needless to say. It's also not the first big down step. January was a big one also, and much sharper than expected. So this is not something that comes out of nowhere. This is the process of a continuum. Moreover, we can rattle off all kinds of economic data here, but to kind of look at the big picture in aggregate, we can see here that first, since mid-November, U.S. economic data started to deteriorate relative to expectations. We talked about it then already, saying that when you look at this Citigroup Economic Surprise Index, which doesn't measure absolute economic outcomes, but measures how realized data stacks up against what the markets are expecting, that you already see that economic outcomes are beginning to deteriorate relative to what the preponderance of economists and market analysts believe they should be. That is to say, the baseline expectations for what the U.S. economy should be doing, that informs most investors, that's not being met increasingly as of mid-November already. There's a bit of a improvement here at the end of the year and into mid-January, but you can see that has now given way. And what you're seeing is an increasingly negative view, not on this indicator or that indicator, but the flow of economic news writ large. Moreover, you see that the closely watched GDP now growth forecast from the Atlanta branch of the U.S. Federal Reserve, which takes in incoming economic data and with each revision adjusts what it thinks the GDP growth number is going to be for the incoming quarter. You can see that this has gone nowhere but down since the beginning of February. So it's not as if we're cherry picking the data or we're looking at measures that are too relative or too soft. What we see is that this nowcast, which in real time takes in economic data and adjusts its expectations accordingly, has had cause to adjust those expectations in only one direction over the course of the past month or so. And what this should be telling us altogether is that clearly the picture on U.S. economic growth has darkened and the markets have seen it. Now, as we've talked about even just earlier this week on the show, the most troubling part of this entire narrative, as though the slowdown in the quintessential service sector in the U.S. were not enough, is that it speaks not just to weakness in the U.S., but to a gathering threat of a recession at a global scale. The reason is global growth is made up of really three major engines: the US, the Eurozone, and China, which collectively account for 58% of GDP. Moreover, their influence is actually even greater than that suggests, because much of the rest of the 42% of countries that are not those three are vendors that depend on the former three for demand. So think Canada and Mexico. For the US, think Central Europe, Eastern Europe, Nordic Europe. For the Eurozone, think Australia, New Zealand, and commodity producers from Africa to Latin America to Southeast Asia for China. They need the three big engines of demand to be buying things in order for them to have a meaningful contribution to global GDP. And what you find here then is doubly concerning, because as the PMI data shows us, you're not going to get much help from either the Eurozone or China if the US slows. Look at the picture that's developed since basically the middle of last year. We get a strong US economy, which we can see, again, looking back at the data, here's that same strength, and you can see what it's powered by. It's certainly not manufacturing. It is the service sector. So you get this strength in the US at the same time that those analog composite readings, composite PMI readings for the Eurozone and for China are going in the wrong direction and converging on standstill. That 51.4 is the expectation for where these numbers come out for February when they're published next week. We'll see where they go. The official numbers also due next week. Those are not from S&P Global, which is what this is. They're from CFLP, China's official sort of grouping on purchasing and logistics that's attached to the National Bureau of Statistics and the Ministry of Finance that produces a rival PMI set from official sources. And as we looked at earlier in the week, it's even more dismal than the S&P Global version of the numbers. So we clearly see a situation where the global economy, if it were normally standing on three pillars, has been really teetering on one since the end of the first half, give or take, of last year. And with these most recent PMI numbers, what's happened isn't that Europe and China have gravitated and converged on US strength. It's that the US has converged on their weakness, which understandably raises the question, well, if all three engines of global demand are misfiring, how exactly is it that you're going to avoid a global recession? What exactly is left standing in its way? Now, you might have expected that with such strength last year in the world's largest consumer market, you would in fact see economies with prodigious exporting capacity, like the Eurozone in the guise of Germany, certainly in Italy, and of course China, still even after its many lumps that it suffered in the wake of COVID, still the main source globally, the main middle step globally for value add manufacturing, still the central node for the global supply chain, albeit a diminished one. You would expect that this robust demand from the largest pocket of end demand would spill over. But not even Canada has been able to benefit from a U.S. strength, and it is quite literally attached at the U.S.'s hip. Close to 80% of Canadian exports go to the U.S., and it's because the weakness in the U.S. and the strength balance has favored services. That's been strong, as we've seen, and that's mainly serviced by domestic firms. Whereas to see these other economies converge upward on the U.S., you would need that demand to come from goods, which is the stuff that the U.S. imports. So as we look then at what this means, the growth scare is entirely understandable. Not surprisingly, the markets have responded by significantly revising to a more dovish setting their expectations for Fed monetary policy. We take a look at where we were just about a week ago. The cumulative tally for rate cuts this year and next was 55 basis points. That amounts to basically 2 rate cuts, if the standard clip of 25 basis points a pop is what you get. Now we have just that for 2025, which roughly lines up with what the Fed anticipated in December. We're still a bit light to what they anticipated for next year. The markets have gone from pricing in about 17, 16 basis points for next year a week ago, so about a 50-50 shot of one cut, to now fully baking that one cut in. You can see here significant dovish revision. We are now at 83 basis points in total for these coming 2 years, this year and next. Still a bit light relative to what the Fed anticipated. They think that 100 basis points in cuts is what was on the menu when they last revised this in December. But clearly, the markets have seen a growth scare. Clearly, their response was, okay, now the Fed needs to come and rescue the economy. It needs to step up the pace of easing, and it needs to do more easing both this year and next year if it is going to head off this concern and get us back to some semblance of a glide path to soft landing. And engaging whether the Fed is likely to do this or to dither, we get this inflation data that we mentioned at the top of the show. Now, the expectations here are actually for a little bit of an improvement. The headline number here expected to come in from 2.6 to 2.5% year on year, a little bit of a down tick after a couple months of accelerating inflation. But what we can see is that actually this acceleration really was less about any changes in this massive core services component where most inflation lives, and more about energy rebalancing from being a negative influence to statistically rebasing closer to zero. And as that has slowed down a bit, you've seen the expectation that inflation will start to come back in. The real story is at the core, which approximates this services wedge right there, and really is where the Fed has agency. They can't really do much about global food and global energy prices, and housing has been a stable uplift on inflation for the most part, and really needs the Fed to cut more and bring mortgage rates down to bring both buyers and sellers back into the market. So that part is just waiting for rate cuts to have their effect. It's the services part that the Fed is really turning the dials on, or at least attempting to. And so that we're expecting 2.6% year on year, which would be the lowest core inflation reading since June 2024, should be relatively encouraging. Now, if we look at the incremental dynamics here, we can see that they've been, for the most part, helpful. If you look at the annualized 3-month change in core PCE, it's recently come down. If you look at what's been happening with the 6-month rate of change annualized, it was a bit dicey going into the end of last year, but come December, things started to tick lower a little bit, even though what you saw was a little bit of an upswing in the month-on-month readings. So maybe the Fed recognizes this, and perhaps these numbers, whatever they do, maybe they don't take us too far off course. Having said that, of course, the PCE numbers generally are not a source of great surprise for markets, because by the time they come out, you've already had the CPI report, you've already had the PPI report. Their internals have made their way into forecasting PCE. So the market is very rarely surprised by what the PCE number brings. So ostensibly, whatever relief you now expect, if you get numbers that are basically on forecast here, as you tend to see, then there isn't much of a positive catalyst there. There isn't much of a relief. This is already in the price of assets for the most part. Moreover, if this is anything like the last CPI report, that one surprised meaningfully higher at both the headline, where you have this rebuilding of the influence from energy, but also at the core. And this is the part that ought to be most interesting, because on one hand, this seems to tell the Fed, not so fast. You can't cut quite so easily. But of course, on the other hand, if we look at where any weakness in these numbers came about, we can very clearly see that this service sector component was again weaker and speaking to precisely what we're seeing in the PMIs, precisely what we're seeing in other data. A sign that the essence of what has held up U.S. growth is giving way with all of its negative consequences. And so as we look then to what this data might do, if we suspect that we're not likely to get a big surprise, then any sort of reasoning that would suggest, oh, well, as long as you get a downtick, the Fed might be readier to cut, and that's good for markets, that basically goes out the window. We don't need just the expected downtick. That's in the price, and Fed policy expectations, as we see, are already shifting to more dovish footing. What we need from these numbers is something that is a meaningful disinflationary surprise in order for the markets to go, well, the Fed has the ingredients they need. They're going to step up the timetable. They're going to cut sooner. That means help is coming. Maybe now is not the time to panic and put a bit of a floor under these markets, at least near term. If, on the other hand, you get something in line with expectations, well, then the experience of NVIDIA this week might be telling. NVIDIA surprised to the upside. It reported better earnings in EPS terms, better revenues than the markets had in their forecast. But the magnitude of the surprise, the magnitude of the positive uptick was the smallest since the third quarter of 2022. So it wasn't just that NVIDIA did something that was disappointing. It's just that it wasn't enough. What there was to see was already in the price. And what the markets did subsequently said, right, okay, well, that doesn't change anything. Let's get back to our regularly scheduled programming. And the danger with the PCE report perhaps isn't so much that it's going to scare markets with a high inflation number, though, of course, given what happened with CPI, that is, of course, a risk. The danger is that it does very little by itself and just passes and does not give the markets any additional reason to hope that the Fed might be more reactive. And that puts the markets back to this new default that they found. And that default points to liquidation. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I am likewise on with Victor Jones on Tuesdays for the Price of Truth, with Chris for Futures Power Hour Mondays and Fridays. Back with Victor and Tom for First Call on Sundays, writing for the news and insights portion of tastylive.com, and opining at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching this on YouTube, like and subscribe. Happy trading. This is the last show for this week, but Macro Money is back on Monday. Chris and I will see everybody for Futures Power Hour tomorrow. Godspeed.